Use this scorecard when investing your money. How do you determine the best place to put your money? In this episode, you're going to be blown away with the criteria, the optimal features we all want in investments, but sometimes we don't realize how to measure with a scorecard where to put our very serious money, the hard-earned money that we have earmarked for our future. So put on your seatbelt. I'm going to blow you away. My name's Doug Andrew, and if you've watched some of our other educational episodes, welcome back. But this particular episode is going to focus on a scorecard that I put together several years ago. In fact, in my most recent best-selling book, The Laser Fund, this scorecard is found on page 165. It's in black and white and gray tones. So I wanted to put it here in the background in color to show the contrast of how to determine the best place to put your money based upon several criteria, or what I call the features, optimal features that we want when we put money into any type of a savings or investment vehicle. These are characteristics of wealth accumulation vehicles. And down here on the left, I will read these to you in this particular format here. These are like wealth strategies or features we want. We want low risk, okay? We want guarantees if we can get them. Penalties, we don't want penalties. Liquidity, we want liquidity. We want the ability to access our money in the event of an emergency without incurring penalties or triggering tax. We would like our money protected so that it is not subject to the volatility of the market. It's in a safe mode, okay? Leverage. What does that mean? Leverage is where you can use that vehicle where you have money to leverage to be able to do other things without having to tie up that money. You can get 2 or 3 lives out of it, if you know what I mean. In other words, you can own a house, and instead of just letting the equity sit in there, you can use the equity to make money, and the house keeps growing in value. See, that's called leverage. Tax deferred. Now, we like to accumulate our money on a tax deferred basis, so that's a feature most people would like. But how about tax free? That's even better, because most tax deferred accounts, you pay tax somewhere down the road when you withdraw your money, whereas tax-free stays tax-free regardless. Collateral. If you want to go to a bank and borrow some quick cash, you want to be able to say, well, I have money over here at this brokerage firm or in this insurance policy, there's cash value here. You want to be able to use it as collateral without disturbing it. Just say, you know what, if I don't pay this loan back, then you can go get paid back with this resource over here, but I want that to keep making money, and I want to use it as collateral to borrow new money. Does that make sense? Tax deductible payments. It'd be nice to be able to deduct what you pay into it, but not at the expense of creating a taxable event on the back end if you have the choice. I'd rather have tax-free access when I take out the money more than a tax deduction when I put it in. Now, if you can have your cake and eat it too, that would be nice. Disability benefit, what's that? If you have money in there or you're socking away $500 a month, $2,000 a month, that if you got disabled, you could not only access the money without penalty, but it would keep funding. It would keep growing. It would keep putting in $500 a month or $2,000 a month. That would be nice. The last is wealth transfer, and this is where most people, when they end up checking out and when they pass away, they usually leave behind something that would have sustained them had they lived longer. And many times people don't think about that until it's too late, and where they have their money, it's horrible for the people that it rightfully belongs to, who you intended to leave it to. So those are sort of the optimal features we want in investments. Next, I'm going to go down some traditional investments like IRAs or 401ks in the market, mutual funds, a home, CDs or bank account savings, annuities, real estate, and then my favorite one over here, and if you can't tell, it's a almost all green. Let me show you why these others fail so many of these criteria. So let's go down each of these general categories of investments and see which ones are the best place to put serious cash, money you don't want to jeopardize. Money in tax-deferred IRAs and 401ks. And we're going to assume this money is in the market. Yes, there's risk there. So anything that has risk or is negative, it's going to be in red. If it depends, it'll be in yellow. If it's to your benefit, it's in green. Look at this. No guarantees. You can lose money. You can incur penalties if you access your money, 10% penalty. If you don't start taking it out by age 70 and a half, they're going to come and penalize you 50% on what you should have pulled out. Horrible. What's the yellow one? Well, you might incur a penalty unless you borrow your money, but then you have to pay it back. Otherwise, you surrender it. So that's yellow. Protected? No, not from market volatility. Leverage? No, you can't do that. Tax deferred, IRA 401k, yes, tax deferred. Tax free, no, you can't access your money tax free. You can't use it as collateral normally. You do get to deduct the payments. So there's only two green boxes here. Disability benefit, no. Wealth transfer, no. Whoever you leave it to is going to have to pay tax on it when they liquidate it. There's only 2 green out of all those. You see why I don't own an IRA 401k? Never will. Let's go over here to mutual funds. I used to have 3,000 clients in 13 Western states with mutual funds. Well, there's risk in mutual funds. You can lose money. People lost 40% in 2008. There's no guarantees. Penalties? Possibly there are penalties that you might incur by selling early or whatever. Liquidity? Generally, yes. Usually you could sell, even though it's not a good time to sell. You can liquidate and get your money. That's only one of 2 green boxes. Protected, no. Leverage, no. Tax deferred, no. Tax free, no. Collateral, yeah, you can go to a bank and usually borrow money based upon what's in your brokerage account. But how about down here, tax deductible payments? No, not in a regular mutual fund. Disability benefit, no. Wealth transfer, no. Mutual funds only have 2 green boxes. So my clients were never happier than when they got their money out of the mutual funds and over here back in 1980. Hey, let's take a home. Some people say, well, my house, that's a good investment. No, your house can go down in value. There's risk there. It doesn't have any guarantees that it will stay valuable or that it will grow at a certain rate. Penalties, usually there's not penalties to act. You might pay it off early and maybe the mortgage company does, but generally no. Can you access your money? Sometimes with an equity line, but if you wait to get it, many times when people need their equity, the worst is the hardest to get because they have to qualify. So that's yellow. Protected? No. How about leverage? No, you sort of purchased it with leverage if you took out a mortgage. Tax deferred? No. Tax free? If you sell your home and buy another one, there's IRS limits to it, so that is yellow. Collateral? Yeah, you can use your house as collateral up to a certain percent loan to value. How about tax deductible payments? The interest portion only is tax deductible up to certain limits. Disability benefit? No. And a wealth transfer? Well, there's IRS limits on how much you can leave behind to your non-spousal heirs in a house. So here we are again, only 2 green boxes. There are 1, 2, 3, 4 yellow, but the rest are red. A home really isn't that good of an investment. So let's go to CDs and bank savings accounts. Risk, generally not. You got FDIC insurance. How about guarantees? Yeah, usually they'll guarantee you 1% or your principal. Penalties, sometimes if you have money in a CD, they'll penalize you if you redeem it early. Liquidity, yeah, they have a drive-up window. You can go get your money and get a sucker too, okay? Protected, not really from inflation, market volatility or whatever. I mean, it's such a nominal, pathetic rate of return. Leverage, no. Tax deferred? No, unless that bank is in an IRA over here. If you talk about tax-free, absolutely it's not tax-free, but you can use it as collateral. When we go down here, tax deductible? No. Completion or benefits? No. Wealth transfer? No. You look at the bank and the green ones, you got 3, 4 green boxes. All the rest are red. But what's the problem with the bank? You're rowing upstream at the rate of 1 mile an hour, and the current of inflation is coming down at 3 or 4. You're going backwards. How about annuities? Annuities are savings accounts with insurance companies. There's some possible risk if you have a variable annuity in the market. Possible guarantees, but not always. Penalties, yes. If you cash in early, there's usually penalties. How about liquidity? Yeah, but you might incur penalties if you go access your money. How about protected? No, that's determined by state law, but leverage, no. Tax deferred, yes. That is the one green box on annuities. And you know how many annuities are sold in America? All the rest of these, it's not tax-free. You can't use it as collateral. You don't have disability benefits. Annuities, pretty pathetic. But a lot of people, I think, are coerced or convinced to put their money in annuities. How about general real estate? It's sort of like a home. No on these because you have risk in the real estate. It can go down in value. Yeah, you don't have guarantees. There's usually not penalties on real estate to access your money. You can access your equity if you have an equity line and you qualified for it first. Don't wait to try to go access money after you are hard up. But down here, protected, no. Leverage, you purchased it with leverage, so it's already in that mode. Down here, tax deferred, no. You can take out money to certain IRS limitations or do 1031 exchanges and so forth. But when you talk about general real estate, you can use it as collateral. You might have some type of tax deferral on an exchange, but there's no disability benefits or wealth transfer advantages. So real estate in general only had 2 green boxes. Golly! All of these traditional places only have a few green boxes that are to your advantage. Why do people put so much money in those vehicles? Do you know where I put my serious cash? Over in this one. Now, there's question marks there. This one is called my laser fund. It passes all of these criteria with flying colors. So let me show you why and how. I'm going to give you the opportunity to get a free copy of this book to understand it more if you would like. But the laser fund is my favorite vehicle for serious cash because you can establish it so it doesn't have risk. When the market goes down, I don't lose. When the market goes up, I make money. It is backed by the legal reserve insurance industry, which cross-insures each other. This is where banks put their money for safety. Guarantees. You have guarantees that you will not lose money due to market volatility. Most vehicles don't have that. Penalties? Sometimes if you took out money the dumb way, which I've never recommended, you do it the smart way and then you do not have any penalties. But everything else is green. Yes, you have liquidity, access to your money. It's protected. You have safety of principal. And in a year that I make money, that becomes newly protected principal. I will never lose the money I've made in the past in my laser fund. How about leverage? Oh yeah, I can leverage that all day long. I can go use that as collateral at a bank. It's tax deferred. But it's not just tax deferred, it's tax free. So when I accumulate $1 million tax deferred and it's earning 10%, I can pull out $100,000 a year and that's tax free. IRAs or 401ks don't do that. None of these do that. When we talk about tax deductible payments, that's the only one that's red. I cannot deduct it. It's like a Roth. You cannot deduct what you put into it, but all the rest are green. It can have a disability benefit that completes. It can transfer tax-free to your heirs. I've been a financial strategist for 45 years. There is only one vehicle in the Internal Revenue Code that I'm aware of that has all the green lights except for one. You can't deduct the payments you put into it. But in my books, I actually show you how to turn that box green. It's by marrying 2 strategies together. So I like to have my cake and eat it too. If you would like to, you can learn how to have a laser fund and have all those green boxes and even turn the last one green by learning how to combine concepts so that you can get indirect tax deductions, which are equivalent to putting it in with pre-tax dollars, but not at the expense of giving up tax-free income on the back end. So I would encourage you to watch this episode so you understand how to create a generator, not outlive your money. And in that, you can go to laserfund.com, get a free copy of this book sent to you for a nominal $5.95 shipping and handling. You will see this on page 165 of the book, and you'll begin to learn how you can empower yourself to do this instead of all of these that have red boxes. Go green.